Welcome back to our channel. Today, we're diving into the exciting world of commodities investing, focusing on gold, oil, and other essential resources. Whether you're a seasoned investor or just starting, understanding commodities can help you diversify your portfolio and potentially increase your returns. So, let's get started. It can feel like a world reserved for experts, a world of complex charts, fast-talking traders. But it does not have to be. Investing in the raw materials that power our planet can be straightforward. It can be accessible. This essay is your guide. It is designed to cut through the noise. It promises to give you simple, clear steps to understand this vital part of the global economy. We will break it all down, piece by piece. You are about to learn what commodities truly are. You will see why ordinary people, not just Wall Street professionals, choose to invest in them. We will walk you through the most popular choices: gold, oil. The goal here is not to make you an expert overnight. The goal is to give you a foundation, a playbook you can understand in minutes. Think of this as a conversation. Skip the jargon. Get straight to the facts. The path forward starts now. What is a commodity? Let's start with the basics. It is a raw material, a basic good. These are the building blocks of the global economy. Think about your morning. The wheat that made your toast, the coffee in your cup, the gasoline derived from oil that fueled your car or the bus you rode. They are produced in massive quantities around the world, and they are standardized. A barrel of oil from Saudi Arabia is, for trading purposes, the same as a barrel of oil from Texas. A bar of gold is a bar of gold, period. This standardization is key. It is what allows commodities to be traded on large global exchanges. Buyers and sellers from all over the world come together to agree on a price. This constant negotiation is what you see reflected in the daily price updates on financial news networks. The list of commodities is vast: gold, silver, crude oil, natural gas, corn, soybeans, sugar, copper, aluminum. So, when you hear about the commodities market, it is simply the giant worldwide marketplace for all these raw goods. It connects the farmers who grow wheat with the bakeries that need flour. It connects the oil drillers with the refineries that produce gasoline. And it connects investors, who may never touch a single barrel of oil, with the price movements of these essential materials. These goods are fundamental to our daily lives. Their prices can affect everything from the cost of your groceries to the price of a plane ticket. You might have a savings account. You might own some stocks. So why add something like gold or oil to the mix? The problem for many savers is a quiet fear. The fear that your hard-earned money will lose its value over time. You see prices for everyday items going up. That is inflation. You also see the stock market, which can be a great engine for growth, sometimes fall dramatically. Economic uncertainty can make even the most stable-looking investments feel shaky. It can feel like you are on a financial roller coaster, with sudden dips that you have no control over. This is where commodities can play a unique role. They do not always move in the same direction as stocks and bonds. Sometimes, when traditional financial assets are struggling, commodities can perform well. This gives you another tool in your toolbox, one that works differently. The solution is to think about diversification. Commodities can provide it. One of their most famous roles is as a hedge against inflation. When the cost of living rises, the price of raw materials often rises too. Certain commodities, especially gold, are also seen as a safe haven. During times of political instability or economic crisis, investors often flock to gold, believing it will hold its value better than paper currencies or stocks. This can add a layer of stability to your overall financial picture. This is not about abandoning stocks or other investments. It is about adding another dimension to your strategy. Think of it like building a team. You do not want a team where every player has the exact same skill. You want specialists. Stocks are great for growth. Bonds can provide income and stability, and commodities can offer protection from inflation and a buffer during uncertain times. By combining them, you create a more resilient portfolio, one that is better prepared to handle the different economic seasons that will inevitably come and go. Gold. The word itself carries weight. For thousands of years, it has been a symbol of wealth, power, permanence. Today, it remains a cornerstone investment for many. The problem for a newcomer is simple. You want exposure to gold, but the options seem confusing. How do you actually buy it? Do you need a shovel and a map, or is there an app for that? Making the wrong choice can lead to high fees, storage headaches, unnecessary complexity. The agitation comes from this uncertainty. You might imagine needing a high-security vault in your basement, or you might worry about being scammed by a less-than-reputable online dealer. The fear of making a costly mistake can be paralyzing. You need a clear, simple breakdown of the legitimate ways to get started. The solution is to understand the 4 main paths to owning gold. Each has its own pros and cons. The first and most traditional way is buying physical gold. This means purchasing gold bars or coins. The appeal is tangible. You can hold your investment in your hand. However, you must consider the costs of secure storage and insurance. Selling it also might not be as quick as selling a stock. It is a solid choice for those who prioritize physical ownership above all else. A second, and very popular, modern option is a gold ETF, or exchange-traded fund. Think of it as a stock that tracks the price of gold. You can buy and sell shares of the ETF through a standard brokerage account, just like you would with shares of Apple or Ford. This method is incredibly convenient, has low fees, and removes the need for physical storage. For most beginners, it is the simplest and most efficient way to invest in gold. A third path is to buy stocks of gold mining companies. When gold prices rise, these companies can become more profitable, and their stock prices may increase. However, you are also exposed to risks specific to that company, like management issues or mining accidents. A fourth way, for advanced traders, involves gold futures contracts. These are agreements to buy or sell gold at a specific price on a future date. They offer high leverage, but also come with significant risk and are not recommended for beginners. Physical for tangible ownership. ETFs for simple, low-cost exposure. Miners for leveraged company plays. Futures only if you truly understand the risks. Oil is the lifeblood of the modern world. It powers our cars. It heats our homes. It is a key ingredient in countless products, plastics, pharmaceuticals. Its price is front-page news, influencing economies and geopolitics. The oil market is notoriously volatile and complex. It is affected by OPEC decisions in Vienna, hurricane season in the Gulf of Mexico. For a beginner, investing in oil can feel like jumping onto a speeding train. You hear stories of fortunes made and lost. The price swings can be dramatic. The fear of buying at the peak and watching a crash is a major deterrent. You want exposure, but you need something manageable that won't keep you up at night. The solution: investment vehicles that simplify exposure to oil. Just like with gold, there are several straightforward ways to get exposure to oil without becoming a full-time energy analyst. First, buy stocks of oil companies. Invest in integrated giants like ExxonMobil or Chevron. They do everything from drilling to refining. Their fortunes track oil prices, but they're established and often pay dividends, potential income. Second, oil ETFs. ETFs can track the price of oil or hold a basket of energy companies. Some use futures to mimic crude price moves for direct exposure. Others hold oil stocks for sector diversification. Like gold ETFs, they're traded on exchanges and easy to buy and sell. Third, Master Limited Partnerships, MLPs. Income-focused. MLPs often own energy infrastructure, pipelines, storage tanks. They're known for paying high distributions, but have unique tax considerations to understand. Fourth, trade oil futures directly for experts. Most direct price exposure, highest risk because of leverage. If you're new, consider stocks or ETFs for simpler exposure, and leave futures until you have deep knowledge and a robust risk plan. Choose the path that lets you sleep at night. While gold and oil dominate the headlines, they are just two players in a much larger game. The world of commodities is vast and diverse, filled with materials essential to our daily lives. Many investors stop at gold and oil, missing out on other opportunities. They might not know how to access these markets, or assume they're too niche or complicated. That can leave a portfolio under-diversified. You might read about a drought hitting crop prices or a building boom lifting industrial metal costs and wonder if you could have invested. It can feel like you're on the sidelines watching economic forces play out without a way in. The world of commodities feels like a closed club, and you haven't been given the secret handshake. The solution: learn the other major commodity categories. You don't need to be an expert, but knowing they exist opens new possibilities. Consider agricultural goods: wheat, corn, coffee, sugar, cotton. Prices respond to weather patterns, global demand, trade policies. A poor harvest in Brazil can send coffee prices soaring. A bumper crop in the American Midwest can push corn prices down. Then there are industrial metals. Copper, nicknamed Dr. Copper for predicting economic health, is essential for wiring, plumbing, electronics. Other industrial metals include aluminum used in airplanes and soda cans, and nickel used in stainless steel and electric vehicle batteries. Finally, other energy commodities beyond crude oil exist, like natural gas, a major source for heating and for electricity generation. Each market has its own story, its own supply and demand drivers, and different ways to diversify a portfolio. Broaden your lens and your options broaden with it. Investing in commodities is not a guaranteed path to riches. It comes with its own set of significant risks. These risks can seem daunting, especially for a beginner. The idea of losing money is always present. In commodity markets, prices can be incredibly volatile, and that fear is magnified. Without a clear understanding of what can go wrong, you are sailing in a storm without a map or a compass. That uncertainty leads to poor, emotion-driven decisions. Example: the price of oil can plunge 10% in a week after an unexpected political deal. Example: a food commodity can spike after a freak weather event halfway around the world. These events are unpredictable. It can feel like gambling, not investing. Fear of a sharp loss can make you sell at the worst time or stop you from investing at all. The solution: don't avoid risk. Understand it and manage it. Let's name the biggest risks plainly. First, price volatility. Commodity prices can swing wildly. Solution: start with small amounts. Don't put all your eggs in one basket. Diversify across assets so one downturn doesn't devastate your portfolio. Second, specialized knowledge. Trading futures is complex. Solution: stick with simpler products like ETFs or stable company stocks while you learn. No shame in starting with the basics. Third, physical commodities, storage and costs. Owning gold bars requires secure storage and expense. Solution: use ETFs if you don't want the logistical hassle. Finally, geopolitical and supply risk. Wars, embargoes, and disasters can disrupt supply instantly. Solution: stay informed, but don't trade every headline. A diversified, long-term approach is your best defense. For every risk, there's a sensible, straightforward management strategy. We have covered a lot of ground. We have defined commodities. We explored why they can be a valuable part of a portfolio. We looked at ways to invest in gold. We looked at ways to invest in oil. The problem now is one of action. With all this new information, it can be easy to feel overwhelmed. What should you do next? The sheer number of options can lead to analysis paralysis. You spend so much time thinking about the perfect first move and never make any move at all. This feeling of being stuck is agitating. You have done the reading. You understand the concepts. But the gap between knowing and doing feels vast. You might worry about picking the wrong ETF, or opening the wrong type of account, or timing your first purchase poorly. This hesitation is the final hurdle for most beginners. It is the voice in your head. Maybe I'll just wait a little longer. I need to do just a little more research. This cycle of delay can last months or years. The solution: adopt a simple step-by-step plan, a clear 5-part playbook to get you to your first commodity investment. First, define your goal. Why are you doing this? Hedge against inflation, diversify away from stocks, chasing growth potential. Knowing your why will guide decisions. Second, start small. This is the most important rule. Use an amount you're comfortable experimenting with. Think of it as tuition for real-world education. Third, choose your vehicle. For beginners, an ETF is often ideal. Low cost, easy to trade, instant diversification, broad commodity ETF, gold-focused ETF, or oil stocks exposure. Fourth, make the investment. Open a brokerage account if needed. Many offer commission-free trading. Place your buy order. Doing it, small scale, is powerful learning. Fifth, review and learn. Watch how your investment behaves. Read related news, not checking every 5 minutes. Connect what you own to what happens in the world. In the end, this is what you need to remember. Commodities are the raw materials that build and power our world. Investing in them is not some dark art. It is a way to add a different kind of asset to your financial plan. They can help protect your money from the slow burn of inflation. They can provide stability when the stock market is shaky. They offer a way to invest in fundamental global trends. You do not need a fortune or a PhD in economics. The paths are clear. Gold, oil, holding a physical coin, buying a simple ETF with a few clicks. Volatility, complexity, unpredictable global events, and we've paired each one with a simple, common-sense solution. Start small, diversify, stick to what you understand, learn as you go. This is the core of the playbook. It is about being prepared, not about being perfect. It is about taking measured steps, not giant leaps. Your journey into the world of commodities does not have to be a 10-minute sprint. It can be a long and rewarding marathon. The key is to take the first step. Do not let the vastness of the topic paralyze you. You now have the foundational knowledge. You have a simple action plan. The most important thing you can do now is to build on it. Take one small, concrete action today. Right now. Pick one of the commodities we discussed: gold, oil, copper, wheat. Go to a financial news website and look up its price chart for the last year. Find one ETF that tracks it and read its one-page summary. That is it. This simple act of looking something up will make it more real. It will transform an abstract idea into something tangible. Your financial future is in your hands. Keep learning, keep moving forward, and good luck. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more investment insights. Thanks for watching, and happy investing.